Whenever somebody asks me, what is the best investment that needs to be done? The first thing I do is to ask them if they plan their tax saving investments. Yes, my friend, tax saving investments needs to be one's first investment. Do you know why? Do you like to get two benefits out of one investment? Then tax saving investment is the first one that you should go to. Reason being is that apart from getting returns on your investments, you will also end up saving a lot of tax. And that's really the argument for why one must first fulfill their tax saving investment options. Now, I'll give you a simple arithmetic argument. Let's say somebody invests just a lakh of rupees at a 7% assumed rate of return. In an ordinary investment, all he gets is that 7%. But the same investment, if he does in a tax saving investment option, and he got the same 7%, because he also ends up saving tax, the rate of return that he enjoys tends to double. On that 7%, the return turns out to be 15%, my friend. Yes, it's 15, it's double the amount of investment. So why wouldn't you as an investor look at making these tax saving investment as your first option? The important reason why tax saving investments are important is, of course, like I mentioned, you get a much better return on your investment. And isn't that what we want? But more importantly, friends, India as a country does not have a very strong social security, meaning that in the event that something were to happen to our jobs or post-retirement, the country cannot take care of your needs. You will have to take care of your needs. Some of these tax-saving investments, especially like PF and NPS, are long-drawn investments that can help you bridge the gap in creating that social security for yourself. So very important in a country like India. So there are multiple reasons why one must invest in tax-saving schemes, but these are the primary ones. Let me tell you what is tax-saving investment. Under Section 80C of the Income Tax Act, the Act allows you to invest up to 1,50,000 rupees per year into a variety of different instruments or a combination of these. It can be your LIC or your life insurance premiums. It could be your PF, your PPF, Sukanya Samriddhi schemes, long-term fixed deposits, equity-linked saving schemes. It can be a variety of these instruments that you can put your money into and thereby enjoy the benefit of tax saving. Additionally, you also get the benefit of putting your money into NPS to the extent of another 50,000. So overall limit for tax saving is 2 lakhs, out of which 1,50,000 in a variety of different instruments and an additional 50,000 in NPS. These put together can give you a substantial tax deduction from your salaried income and also create a corpus for you at the side. Isn't that very, very interesting, my friends? What happens to somebody who does these tax saving investments of 2 lakhs every year diligently over long periods of time? Let's assume a 30-year-old person continues to do these tax saving investments of 2 lakhs every year over the next 25 years. Net result is, even on a very low rate of interest of say 7%, he ends up having a corpus of almost 1.26 crores. And that too on a very small investment of just 40 lakhs. It's an amazing way to create a long-term corpus for our needs. So tax saving is the first investment that one needs to go to, and I hope you will remember this message.